From the Institute for Research on Public Policy, this is Demystifying Community Housing, a special series from the Policy Options podcast in collaboration with Community Housing Canada. I'm your host, Ricardo Montrose. Last episode, we discussed the social, economic, and human rights aspect of the community housing sector in relation to Canada's housing crisis. In this episode, we'll hear from Alex Hemingway, Christina, Maes, Nino, and Steve Pomeroy on the various challenges facing the community housing sector and how to bolster its resilience. SFU professor Yushu Zhu, along with students researchers Hanan Ali and Natasha Muhiro, facilitated the conversations you're about to hear. These conversations were recorded on the unceded and traditional territories of the Musqueam, Squamish, and Tsleil-Waututh people, and the Kanien'kehá:ka Nation. We also had the honor of speaking with guests located on the traditional unceded territories of the Algonquin Nation, the traditional territories of the Musqueam, Squamish, Tsleil-Waututh people, and on Treaty 1 territory, the homeland of the Métis people. Let's now dive into today's conversation.
The community housing sector in the Canadian context is a relatively small part of the housing system, as recently pointed out in publication from Scotiabank. Social housing, affordable housing, roughly 4% of total housing stock, about half the OECD average. And that's not much different than other sort of Anglo colonies of the US, Australia, New Zealand. We certainly see the OECD averages pulled up by significant proportions of social housing in Western Europe for reasons related to wartime destruction and rebuilding.
This is Steve Pomeroy, industry professor at McMaster University and the executive advisor to the Canadian Housing Evidence Collaborative. He has 40 years of policy research experience in housing affordability, homelessness, and other urban issues.
I think one of the key challenges for the sector is that it grew quite significantly between sort of the mid-1970s to 1994, so about a 20-year period, and then essentially went into a period of significant stagnation as a result of the termination of federal housing programs in 1993, a little bit continuing on in BC and Quebec, but most of the country essentially dormant. And then a re-engagement at the federal level in 2002 through the Affordable Housing Program, which sort of helped to build some affordable housing, give or take 5,000 units a year. So much less than we had done in the heydays of the 70s and 80s when we were doing about 25,000 units a year.
And I would say the nonprofit sector is, well, they are established to provide good, affordable housing over the long term and have done that. And many organizations are very strong at that.
This is Christina Maes Nino, the executive director of the Manitoba Nonprofit Housing Association. A long-time social housing and social policy practitioner, she explains the significant unmet demand for community housing.
The scale at which we do it is not nearly enough to address the need. That started to grow. I would say we're well positioned to meet those chronic housing needs for specific populations. That's many nonprofits have been set up to do that. We can and should be serving all the renters who need housing, but we're not there yet.
Now, some amount of public funding for housing has returned over the past several years, both federally and provincially here in British Columbia, but not at levels that are anywhere near enough to meet the need and address the huge backlog of need for housing from those decades of underinvestment.
Alex Hemingway, a returning guest, is a senior economist and public finance policy analyst at the Canadian Centre for Policy Alternatives BC office, whose research focuses on public policy issues related to inequality, taxes, public finances, and housing.
So a big challenge remains quite simply funding, public funding. The existing federal and provincial housing programs are too small, they're oversubscribed, and that means that good non-market projects that are being proposed are getting passed over for funding at a time when they need to be built urgently and at scale.
What you've just heard shows how the consequences of government divestment in community housing are still felt today. After nearly 3 decades of supporting the rapid development of public and social housing, the federal government terminated all new funding for social housing in 1993, freezing the sector's growth. While some provincial initiatives continued, overall production levels fell off. Responsibility for the management of the existing social housing stock was downloaded to provincial, territorial, and municipal governments. It was not until the launch of the first National Housing Strategy in 2017 and the passage of the National Housing Strategy Act in 2019 that we saw meaningful re-engagement of the federal government and housing policy. Despite the many positive stories we heard in episode 2 about life in community housing, significant challenges and limitations continue to threaten the growth of the sector.
There's a decline in the longer-term legacy subsidies that are attached to the existing social housing, that 600,000 or so units that we created historically. And there the challenges are twofold. One is without the subsidies, preserving the units at low rents, rent geared to income rents, without ongoing subsidy is obviously a challenge, depending on which program one was in. And secondly, those assets which we started building in the 1970s are now 40, 50 years old, and they're at an age of the building life cycle where they're in need of fairly significant capital renewal. And again, without the funding, it's very, very hard to do that. And I think that's the key sort of sustainability challenge for the existing stock is basically sourcing new source of revenue.
The decline in legacy subsidies continues to erode the existing stock. According to the 2023 Social and Affordable Housing Survey, nearly half of the existing community housing units were built more than 40 years ago, before 1980. More than one-third were built between the early 1980s and the early 1990s. Only about 77,000 new units were added over the past 25 years, 30% less than what was built the decade before.
The way that community housing was built over time was that they, from the 1970s until now, was that they were built under these long-term operating agreements. And so they have an operating agreement was attached to the life of the mortgage. And so they received funding from government to pay for the financing and sometimes some additional operating costs. And in exchange, they were meant to provide either a portion or 100% of social housing, so rent geared to income housing. And those agreements were really positive in the sense that they were long-term, and they were really negative in the sense that they were set in stone over the long term. So the ability for organizations to adapt over time was more limited than it would be in an ideal world. So organizations haven't been able to be as flexible as they would like to be. Some provinces have changed that model. Many provinces are in the midst of changing that model because more and more of those agreements are ending, and they're sort of figuring out what to do, how to offer the stability, but also increase the flexibility. So those needs in terms of like the building itself, the ability to renovate the building, to change the income mix in the building, those are often tied to the agreement and are pretty inflexible.
Fast forward to 2024. Many operating agreements have now expired or are expiring in the next few years. For nonprofit housing providers, this means that once their mortgage expires, so do their funded operating agreements. Housing providers must then survive on their revenues alone, mostly rental revenues. For some organizations, the elimination of their mortgage debt is enough to cancel out the effect of losing the subsidy. In these situations, expiring agreements can mean improved financial viability and flexibility. But the end of operating agreement and subsidies could be problematic for organizations that provide primarily housing with rents set as a percentage, often 30%, of the tenant's income, or what's known as rent geared to income, or RGI units. Most of these housing organizations opened their doors after the 1985 policy changes intended to boost housing provision to low-income households via RIG subsidies. In their case, the subsidy they need to cover operating costs is greater than their mortgage loans. When they lose their subsidy, even if they no longer have mortgage to pay, these organizations could face financial challenges. This is especially the case with inflation and rising operating costs.
The fact that the subsidies are expiring, that's coincident with the maturing of the mortgage. So they no longer have to make any mortgage payments, so that's beneficial. And certainly for the projects that, certainly in units in projects that expired up to 2021, the subsidy mechanism in that particular program was one where the total amount of the mortgage was bigger than the subsidy. So when they both expire, you're actually better off. And there's a little bit of surplus cash flow. So the ones that we've seen expiring to date have generally been able to be sustainable, although they do face challenges in funding their capital renewal because they just don't have enough accumulated reserves in place. The ones that were originally created post 1985, starting in 1986, on the same 35-year subsidy and mortgage arrangement, 1986 and 35, 2021. So the ones that we're now seeing expiring are ones where the amount of subsidy was larger than the mortgage. So when both the mortgage and the subsidy expire, now they're into a negative situation where they don't have enough revenues coming from the rents to be able to cover their operating costs, even though there's no longer a mortgage payment. And also because it's a negative income, they don't have any surplus income available to take it to the bank and borrow to basically fund the capital repairs they need to do. So they need help both in terms of bringing back in some level of assistance to support rent-get-to-income rents.
The post-expiry viability of community housing varies widely across buildings, providers, and regions, depending on the type of agreement, the condition of the building, and the income and rent level mix of tenants. Many housing operators in Manitoba, for example, are facing imminent need for new supports for existing community housing. The operating agreements on 5,000 units have expired. Agreements on another 10,000 units will end in the next few years. Soon, over 1,000 units will be in unviable financial situations. Without subsidies, the buildings containing these units will have a grim choice. If they maintain rent levels, they will have to defer maintenance and watch the buildings fall into disrepair. If they increase rents to fund operational costs, their existing tenants may not be able to pay. In some cases, they may be forced to sell the buildings to private market developers. Steve explains that this is the worst-case scenario that the majority of public, nonprofit, and co-op housing providers work to avoid.
So this is the exact issue I just spoke about, where the subsidies are expiring and their viability is challenged. I think it's incorrect to position this as saying a massive number of these units are going to be transitioned into private hands. All of these units are owned. A third of them are owned by governments, and they're not about to allow them to fail. They'll basically just increase their subsidies and keep them in operation. And the other 2/3 are owned and operated by nonprofits and co-ops who are mission-driven to want to provide affordable housing. So their first response will be to try and fill those gaps, advocate to government to extend and increase, renew subsidies to allow them to continue operating. There have been a few units that have been sold off, but they are the exception rather than the rule. And so I don't think we're going to see a flood of units all of a sudden being sold off and moving into private hands. We may see the odd one just because a particular operator isn't operating as well and just doesn't have the capacity to advocate to government for renewed subsidies. But I think they will be a rare occasion.
To protect social housing from market privatization, Manitoba Housing, a provincial crown corporation, together with the province of Manitoba, established a new funding model called the block funding model. It is meant to provide a more predictable and flexible funding to the housing operators who have recently expired or expiring agreements. Christina explains this more.
So the specifics are not there yet. Our sense from government, what we've heard, is that the model is designed whereby organizations would sort of look at their budgets their actual budgets over the past 5 years, project forward, and instead of the previous model where they would do a line-by-line budget with government and say, we need this much money to operate. Often what would happen is that they would say that they need this much money to operate. The government would agree to give them, 75% of that. Then they would have some sort of deficit at the end. And after a bunch of back and forth, complain, concern, worry, eventually the nonprofit would get most of that funded, and that would continue year over year. Organizations wouldn't be able to put that. That was the operating agreement model, right? That's the devil we know, which organizations, it's better than nothing, but hasn't actually worked that well in the sense that it never actually funded capital reserves to the extent necessary, didn't allow for organizations to put forward plans for the future, wouldn't allow them to keep any surplus. So if an organization had a year where the expenditures were lower than revenues, which does happen from time to time, that would all have to go back to government. So there's never any benefit to reducing costs for organizations. So this new model will, as far as we've heard, will allow organizations to keep a surplus, to put adequate funding into the reserve fund, and will be at 5-year intervals. So 5 years in the housing world is a very short period of time. We plan for buildings. We always recommend planning for at least 25 years. 5 years is not ideal, but it's certainly better than 1 year and better than 2 years. And we've been told that the benefits will be some flexibility. So we do hope that means that every 5 years we can say insurance has doubled. We actually need more, and so we can start to make budgets that are realistic and based on costs that do change over time. So we have a lot of optimism for the model. The main challenge for the model is that we don't know what will happen with deficits. So the other thing about housing is that budgets are, there are big ticket items that you may not predict in a given year. So you might expect your elevator to break. You do a building condition assessment. You expect, in 20 years, I'm going to have to fix the elevator. And actually in 5 years, you have to fix the elevator. And that is ridiculously expensive. So you could also have a year where suddenly you have, especially for a seniors building, suddenly you have a huge turnover because you have 20% of your tenants aging and needing to move into a personal care home. Those things, you try to predict them, but sometimes you can't. And so if an organization has a year where suddenly they have a huge deficit, we don't yet know what that will mean. In the past, under the operating agreement, Manitoba Housing would eventually cover that deficit. And so it's our hope that the new agreement would recognize that and would allow, especially until organizations have a reserve fund built up, allow them to have that covered so they're not at risk.
While expiring subsidy agreements pose challenges when it comes to preserving the existing community housing stock, restrictive exclusionary zoning policies threaten the sector's growth. This is particularly acute in places like Vancouver, where the will and the demand exist to grow the sector. But finding the space to put new housing, especially community housing, is politically controversial. Alex discusses this further.
Another big challenge that I hear from folks building nonprofit housing is at the local level. We have exclusionary zoning and municipal roadblocks to new housing that drive up costs for both community housing providers and private housing providers. So, for example, single family or low density zoning policies in effect ban new apartment buildings on the vast majority of the residential land in our cities. And that drives up the cost of those scarce sites where you're allowed to build apartments. That's driving up the cost of non-market housing and suppressing housing creation in general.
The federal and some provincial and municipal governments have responded to these challenges by changing zoning regulations for moderate densification, though not specifically targeting community housing. The federal government rolled out new funding and programs under Canada's housing plan to incentivize municipalities to remove rezoning barriers to higher density development and potentially speed up development permitting through pre-zoned land. The BC government also introduced new legislations requiring local governments to allow for multiplexes of 3 to 4 homes in single-family zones and 8 to 20-story buildings within set radius of frequent transit stations.
So what we're seeing at the provincial level here in BC is, as I mentioned, we have these highly restrictive zoning policies that make it very difficult to build apartment housing, which is what we need and the type of housing that's going to be most affordable to most folks. The province has stepped in and said, look, we're going to start getting involved in these types of land use decisions. And they've done a couple of things. One is to say, basically anywhere you can build an expensive single family house today in a city, you're going to be able to build a multiplex of up to 4 to 6 units of housing. And that can help ease the overall housing shortage. The other big, one of the other big steps they've taken is to say, where we have major transit infrastructure, like the SkyTrain here in Vancouver and adjacent municipalities, within a wide radius of those stations, 800 meters, you're going to be able to build apartments there as well. Now, I think one important thing that's missing in the provincial legislation, and that should be incorporated, is much stronger province-wide protections for existing tenants in the areas around those transit stations. So if we have tenant protections that, for example, say that existing tenants will be provided with interim housing at their existing costs and allowed to come in back into new buildings at their existing rent, that does two things. That protects those tenants, and it also actually encourages and steers development away from those existing apartment sites. It makes it more economical to build on other sites where there aren't already a lot of renters living.
While these densification policies are well intended to encourage housing supply in general, their effectiveness in supporting community housing supply remains questionable if they are not complemented with inclusionary housing policies. In Metro Vancouver, for example, some municipalities have been using rezoning and density bonuses to incentivize the development of social and affordable housing. And yet, the recent zoning legislation changes in the province call the future of this policy into question. Beyond BC, cities and other parts of the country have made strides toward inclusion of affordable housing within major redevelopment projects. The City of Toronto adopted a zoning bylaw amendment in 2022 that requires new residential developments in designated areas near transit stations to include 5 to 10% of affordable rental and ownership housing. The percentage of affordable housing is expected to increase to 8 to 22% by 2030. Montreal's bylaw for a diverse metropolis, implemented in April 2021, requires developers to include 20% social housing, 20% family housing, and 20% affordable housing units in new projects, exceeding an officially defined threshold. For social housing projects, however, developers could opt to pay cash en lieu. Again, the effectiveness of Montreal's non-mandatory inclusionary zoning policy was under criticism. By October 2023, after more than 2 years of the policy implementation, only 660 social housing units were in the pipeline, and none was built. The vast majority of developers decided to pay cash instead of building social housing. Due to funding constraints and a shortfall of supply, community housing operators face major barriers when it comes to supporting their tenants who are going through life transitions and whose housing needs evolve and sometimes become more complex. Christina echoed concerns similar to the ones we heard in episode 2 regarding the community housing sector's challenges of providing continuity of care, which underscores policy disconnects and governance silos between housing and other government agencies, such as health authorities.
The folks who who tend to live in community housing tend to be people who are going through some sort of life transition. And I use that term broadly. So life transition includes moving to Canada. So you come to Canada, you don't have money for a down payment to purchase a home. Youth, so youth aging out of care, youth aging out of home environment where they're not getting family support. Aging seniors, so seniors who want to live in Manitoba. One of the big issues, and I think this is common across Canada, people want to age in their home community, and in smaller communities there simply isn't rental housing or affordable rental housing for them. So their needs are different from someone experiencing homelessness, but it's still a need that community housing tenants face. Needs are more complex than they used to be. I think across Canada, mental health and addictions challenges are really skyrocketing, and that's largely due to the isolation and loneliness and lack of programming and support that came out of the pandemic. So that's something that our members raise all the time as issues. And there's this idea in that sort of traditional nonprofit housing where you think of yourself as a landlord, they don't have people on their staff team who are providing those tenant supports. They're building partnerships with community resources. Those community resources are stretched. Those community resources are often funded on an annual basis. And so the ability to connect people with those resources is limited. And so they put things in place. So when you talk about sort of regulations, I find community resources, when they're under that strain, they put things in place to limit access. And so one example that I can think of, and this is a long time ago, but it, I think remains common. One of our members told us that they had a tenant who was aging and starting to have some signs of dementia. So she was wandering at night, and her neighbors would call the landlord and say, "Hey, I'm worried about her. She's coming back at weird times. She's always losing her keys. She is leaving her stove on." And so the landlord wanted to connect this person with mental health supports, with whatever it was that she needed so that she had home care or resources. And those resources said, we'll only be able to help her if she's at risk of eviction. So if you give her an eviction notice, then we can come in and support. And the landlord said, "Well, I don't want to evict her. That's not my intention. Our intention is to get her those supports." But that tends to be the case, that the only way to get people the support that they need is to evict, or at least threaten to evict someone, which is not good practice, right? So those sorts of regulations around access to programs can be a huge challenge for nonprofit housing organizations.
Oftentimes, it is the people who operate community housing who end up trying to navigate these challenges to facilitate better integration of care services and community housing.
In Manitoba, and I think this is common in other provinces, certainly from what I've heard from folks in BC and in the Maritimes in Nova Scotia, for example, what often happens is that the nonprofit is the one expected to coordinate funding. So the governments won't coordinate, even internally, sometimes not even within their own department. So the nonprofit can piece together those funding streams. And some have been quite successful. So one of our members, Tendon Sinclair, provides support for people with physical disabilities. And so they are half funded by the health authority and half funded by housing. And so they I think they tell their funders this, that like any gap in one side of the funding, they use the other funding to fill. And that has been very successful. So the executive director's salary is half paid by health, half paid by housing. It's a win-win for health and housing when that happens. That didn't happen because health and housing came together and said, "Hey, we should create this really innovative policy and program model whereby people with physical disabilities who need health supports also have a place to live." It came from people with disabilities who were living in personal care homes but were 20 years old saying, hey, I would really like to live independently as a young person in my community, and I have these healthcare needs and I need a place. And so they came together and said, government, you need to fund this. This is going to work. And to their credit, at the time, governments funded it, and that has continued over time. So the policy has come from community organizations demonstrating that this works, and that has tended to be what is successful. We would love to see it the other way, that governments start to make that realization. I've always worked outside of government, so I don't know how to make that happen. I do know how to make the other side happen, so I do know that organizations coming to government with those solutions and being able to navigate those different systems, as frustrating as it can sometimes be, has often worked well to force those silos to sort of break down and fund programs in some sort of holistic way.
Despite major funding and operational limitations, the community housing sector remains resilient. Operators have embraced the need for flexibility and innovative practices to support their tenants. Many housing organizations are becoming more entrepreneurial, for example, by expanding into revenue-generating activities that support their goals. Steve outlines how some nonprofit housing providers are making this shift toward social entrepreneurship.
So we have seen a few that have sort of figured out other ways to make some money by basically selling their services. They're quite good at property management, at the accounting aspects of real estate management. So they sort of sell property management and real estate services to either other nonprofits or, in some cases, to private organizations like condo corporations. Some of them have basically created development subsidiaries, and they sell the services of their development subsidiary to other small nonprofits they want to build on a fee-for-service basis and generate some revenues doing those types of things. So they're very much at the margins. They're not making serious money, but they are making a little bit of revenue to overcome some of the stuff.
According to a 2015 Housing Partnership Canada survey on new approaches and practices among their 33 member housing organizations, over half, 22, significantly expanded new activities outside of the traditional social housing provider role, while 1/3, 9, characterized their new activity as smaller incremental additions to their ongoing social housing role. One successful example of the social enterprise model of nonprofit housing society is the Nemarin Housing Corporation, an Indigenous-led organization based in Regina, Saskatchewan. In response to the expiring federal subsidy for its affordable housing units, Nemarin started to engage in revenue-generating activities in 2006, transforming its nonprofit business model into a social enterprise model. The corporation sold off aging and less desirable building in its portfolio to raise the initial capital needed to start its new businesses. The for-profit businesses they have engaged in today include property management services, a retail mall, a pharmacy, a contractor warehouse with rental storage space, and acquiring condo units. The revenue generated from these for-profit businesses flow straight back up into supporting its core mission of providing affordable housing for Indigenous people in their community. We'll feature Nemarin's story in our next episode, but this example demonstrates a cross-subsidization strategy adopted by some nonprofit housing operators, which allows them to cross-subsidize deeply affordable housing with market or below-market rate housing, or other business activities.
We've gotten a little bit into mixed income in new development, but we haven't really did the big surplus kind of piece. I think what we are seeing, the mixed income model is an inevitable consequence of the funding model we currently have, which is very much loan-based as opposed to deep contributions, which we used to have in the previous pre-94 programs. So you simply don't have enough deep subsidy to build 100% low income. So they build projects that have a mix of targeted near market and some above average, but more profitable market. So there is a degree of cross subsidy within the projects happening there.
One of the main ways that organizations have generated revenue is they have an asset, and so they can, if they're not one of those buildings that were built with 100% rent geared to income units, they have mixed income units, and so they can rent out some units at market, some units at like a premium rate, even depending on their location. And then some units are subsidized. And they also might have commercial space that they can lease out. So that also helps to allow them to both serve their tenants through having either a local business in their building or a social service organization that's paying some rent. And so they're providing affordable housing in that sense. So some nonprofits have done that here and have done that successfully.
The cross-subsidization strategy has not been picked up by all jurisdictions across Canada. In Manitoba, community housing units rented at market rates or break-even rates only account for less than 2%, compared with 32% in Quebec and 22% in BC. The limited scale of cross-subsidization in some places compared to others may have to do with the local context of housing dynamics, according to Christina.
This idea that every nonprofit housing organization can turn into a Regent Park in Toronto is here in Manitoba, we sort of laugh because you certainly can't charge the rents in the inner city in Winnipeg that you can charge in the inner city of Vancouver or Toronto. I visited a building in Victoria where they were building premium suites above single room occupancy supportive housing for people with addictions and mental illness, and people would pay those premium rates. That is not a thing in Winnipeg. It's not a thing in Brandon. It's not a thing in any community in Manitoba. No one will pay for that because people can buy a house for much less than those premium rents. So it's important to recognize that housing markets are very local and vary a lot.
While there are many innovation success stories in the community housing sector, Christina commented that many organizations are not so much transforming as they are evolving and adapting to the new funding environment.
So this idea that we can all be entrepreneurial can be concerning when governments, especially national governments, think that we can all do that. Others have done so in Saskatchewan. Enamoran Housing is a great example. They do a lot of really entrepreneurial activities. They've had to do a lot of that out of necessity. Their government hasn't supported them as their agreements end. So they do snow clearing for other housing providers. They have a bunch of different social enterprise activities that they use to both support their housing and to have enough revenue to support their housing. So that does happen. I think the expectation that every housing organization can do that is a problem. But the ones that do it have been quite successful and it's worked well.
There is a more fundamental issue. That is, the policy environment and culture in the nonprofit sector in Canada are not necessarily conducive to fostering the entrepreneurial transformation of community housing. Steve highlights the incompatibility between the policy environment and entrepreneurial spirits of nonprofit organizations.
If we compare the Canadian housing sector to other countries, the UK, the Netherlands, France, even Australia, we see in the other countries much greater sort of degrees of what I would call social entrepreneurship. To some extent, that's a condition and a situation they've been put in because of the design of our social housing programs, where the subsidy mechanisms were such that, from purposes of public accountability, if you were a non-profit provider and you generated additional revenues, the government turned around and reduced the subsidy. So you were penalized for actually being creative and being efficient. And so that's the kind of culture that we've created in our non-profit sector, and that doesn't really help us get out of the current kind of context, other than for them just to simply go and ask government for more money. Because we've got a situation where we have tried to create nonprofits and set rents really low, it's very, very difficult to manage real estate assets. You can't basically build assets or manage assets and repair assets with really, really low rents. What the other countries have done is allowed the rents to actually be set at a much more realistic cost-based rent level. And where people can't afford them, they've provided a layer of additional subsidy in the form of a housing allowance or a housing benefit. And it's having that additional revenue that creates the capacity for them to be more entrepreneurial, because they have positive cash flows, they can create reserves, and they can use their positive cash flows to go to lenders and borrow against their assets. Our nonprofits, because they're nonprofit and they don't have any surplus cash flows, even though they have an underlying land value and they have they have so-called equity in the land, that equity has no real value to them because they can't extract it, because a lender won't lend the money if there's no capacity to repay the loan. So that really does hamstring our providers from becoming entrepreneurial.
Canada's housing policy landscape has supported and created a dualist system, where in most cases the community and the market housing sectors are siloed rather than competing or collaborating. The former is viewed as marginal and secondary to the latter. The result is a fragmented community housing sector dominated by small-sized organizations that each have a narrow housing focus. According to Steve, Canada's community housing system has evolved on a project-by-project basis, governed under a series of operating agreements with little in the way of an overarching regulatory or governance framework. As a result, most nonprofit organizations lack the capacity to develop and retain the type of leadership and critical expertise needed to transform the sector.
The government programs really don't sort of enable it and support it very well. And also the fact that we've had 50 years of being, the thing about social housing, the word social's in their title, and they see themselves as being a social service. That's and they're very good at providing services to tenants, supporting tenants, doing resident services, and bringing in other kinds of help and community supports. That's a very different set of skills and expertise than being a real estate operator and an asset manager and an asset developer. So we have a very strong skill set on resident services and tenant supports, and not as strong skill set on the asset development side. That does occur in some of the mid-sized and bigger organizations, but that's another part of our legacy problem, is that when we decided to build, when we said large-scale public bureaucracies are bad, and the inverse, small-scale community-based must be good, that transition that we did in the 1970s resulted in us basically creating a funding model that funded a whole bunch of very small organizations of people who wanted to help a particular constituency, whether it was seniors, whether it was an ethnic group, some other low-income group in their community. And they did a very good job of that, except they sort of did one project. So in, I don't know the numbers out there in BC, but here in Ontario, for example, the Ontario Nonprofit Housing Association has 800 members. 700 of them have less than 100 units. So we've got a sector that's dominated by a whole bunch of really tiny providers. They have a bookkeeper and a janitor, and they have a board that's probably been there for 30 years. And they're themselves, they're probably getting bored with being the board, pun intended, and or they're dying off and are no longer around. Ontario only has 10 providers with more than 500 units. And then, most of those big providers tend to be the ones that came out of the municipal housing corporations. So they're sort of another form of public housing. They are doing more entrepreneurial things, although there it's kind of a quirky situation. So it's hard for them because they don't have the same risk tolerance culture. They're overseen by a risk adverse council and those types of things. So we don't, again, the structure of our ecosystem stifles the ability for us to evolve into a more entrepreneurial culture, which has not been the way it has been in many other countries.
So how have Canada's housing policies responded to addressing the systematic challenges and created opportunities for the community housing sector? The importance of community housing in addressing Canada's chronic housing needs was recognized in the National Housing Strategy, or NHS, launched in 2017. The federal government recognized access to adequate housing as a human right in the National Housing Strategy Act in 2019. Through the NHS and subsequent budgets, senior levels of governments committed renewed funding and financing to preserve and grow the sector. For the first time after decades of homeowner-centered policies, in 2024, the importance of 10-year security was officially recognized in the federal government's Canada's Housing Plan, through its commitment to new Tenant Protection Fund and Renters' Bill of Rights. While applauding these government commitments, both Steve and Christina share some reservations about these new initiatives.
The sector over the last 20 years has continued to struggle to actually figure out how could it expand and could it grow to a more significant level. Most of the activity was really focused on preserving what we have, managing what we have, doing capital renewal of aging assets, with a tiny bit of expansion on the fringes as a result of relatively underfunded and programs both in 2002 to 2018. And then more recently, of course, with the expansion of the National Housing or the creation of the National Housing Strategy and its implementation starting in 2018, that has created new opportunities for the housing sector. They've been slow in rolling out and haven't really created a programmatic framework that has enabled nonprofits to serve their traditional clientele of deep need households. It's been more a moderate income, moderate affordability, loans-based type of initiative. So I think the sector has aspirations to grow, but doesn't necessarily have the right policy framework and funding support from governments to be able to do that in any meaningful way.
When the National Housing Strategy was announced and released, there was so much optimism. There was a lot of optimism that it would build a sustainable and a resilient sector. I would say has not yet come to fruition. The funds available, the programs have been frankly disappointing, especially the co-investment fund and now the whatever it's called now, the Affordable Housing Fund. The barriers to accessing that have been substantial and more than previous housing funds, which was unfortunate. However, there has been predictable and ongoing funding for development, and that's been positive. The Rapid Housing Initiative, we've seen some new projects that were desperately needed that are supporting those who need it most. That program provides 100% capital grants, which is really, that's what's going to build really deeply affordable housing.
The NHS includes various initiatives to support the community housing sector. Among the primary initiatives are those Christina mentioned: the Affordable Housing Fund, or formerly known as the National Housing Co-Investment Fund, and the Rapid Housing Initiative. The Affordable Housing Fund takes a partnership approach, encouraging organizations to bring their own cash reserves or other resources to the table. It offers a total of $4.7 billion for grant contributions and $8.5 billion for financing, with favorable terms. The Rapid Housing Initiative provides capital contributions directly to developers catering to groups with deep housing needs. This initiative has provided $3.8 billion to support the creation of over 15,700 new affordable units as of 2023, exceeding its initial target. Alex explains the impact of the Affordable Housing Fund.
The biggest issue, in my view, is the scale of the funding has not been there to match the scale of the need for social housing investment. So take the National Housing Co-Investment Fund as an example. That's sort of the core social housing investment part of the National Housing Strategy. And my colleague Mark Lee compiled some of the numbers around this. He found in the first 4 years of the program, it actually only funded 7,000 new affordable units. It helped with the upkeep of, I think, about 13,000 others as well, which is important too. But just to contrast that, our recommendation at Canadian Centre for Policy Alternatives has been that this program or a similar one should be funding 1 million non-market homes over 10 years. So the current program is falling short by an enormous margin. And we know we have decades of underinvestment to catch up on. So the scale's not there.
The Rental Construction Financing Initiative, now known as the Rental Construction Loan Program, is also a component of the NHS. Its purpose is to incentivize purpose-built rental construction. This initiative offers highly favorable lending terms to rental developers, including nonprofits, that are venturing into mixed-income projects. However, most of the Rental Construction Financing Initiative loans have gone to private developers.
The Rental Construction Financing Initiative is quite a different program. It provides low-cost construction loans to rental housing, both private and nonprofit. And because it's offering repayable loans, its fiscal cost to the federal government is quite low. And it is a real help to making new rental projects work at a time when we're facing those interest rates and other viability challenges. But, I think one issue with that program is it's also oversubscribed, and there really needs to be more of an effort built into these types of programs to ensure that they are available for nonprofit housing providers when they need them. Again, this is a circumstance where they're in competition with the private providers for this funding. I'm fine with providing that assistance to private rental housing, which we need more of as well, but the program should be structured to ensure that basically anytime a good nonprofit project proponent comes forward, that financing is available and it's available quickly. And that's not what we've seen.
The NHS also includes programs like the Canada Community Housing Initiative to address the previously discussed financial challenges caused by the expiration of operating agreements and subsidies for many housing operators. This initiative supports rent geared to income extensions, retrofitting, and redevelopment of the aged housing stock. The Federal Community Housing Initiative is a parallel funding stream. It targets existing social housing, where projects remain under the administration of the Canada Housing and Mortgage Corporation.
The funding in the Canada Community Housing Initiative, as well as the Federal Community Housing Initiative, which is directed more to co-ops, it will continue to increase, and that money should be made available to basically preserve the existing nonprofits and co-ops that were funded under those original agreements. There may be a need to augment that funding a little, particularly as the cost of capital repairs go up, but I think the mechanism is in place, and as long as we stay diligent and potentially increase the levels of funding there, we should be able to preserve that stock. And I think that very much is a priority for both the federal and provincial governments, just because it's so much more cost effective to do that than it is to build new.
As our guest highlighted, despite the renewed public funding and public support for community housing, significant cracks remain in the community housing system. How can we then do better to support the resilience and growth of the sector from a policy point of view? One of the key challenges consistently pointed out by many is the prolonged and continued underinvestment in the community housing sector, as well as barriers to accessing finance and additional funding. To address this, Alex proposes a model of self-supported public financing for community housing projects. This model would shift the financial burden from taxpayer-supported debt to self-sustaining rental revenue streams. It presents an opportunity to increase the scale of public investment in affordable housing while ensuring financial sustainability.
Anyone who's operating nonprofit housing, it does have that rental income stream coming in. And what we're pointing to specifically here with this model is from the perspective of the public sector and capital investment in housing. The way that's structured today, it's almost exclusively booked in the provincial finances as taxpayer-supported debt. And part of what we're putting forward is the idea of, if the public sector wants to get much more deeply involved in housing investment at a much larger scale, it can begin to structure a large portion of this investment as self-supported debt, financed through that rental income, in the similar way that other crown corporations operate, like BC Hydro or ICBC operate sort of as crown corporations that sustain themselves through their own income streams. So if you restructured some of the housing investment along those lines, the capital investment and the debt, the borrowing that's taken on to bring that housing online could be booked as self-supported debt in the way that's done in those other crown corporations. That has not been the typical model that's been done in public housing investment in BC to date.
Gaining access to low-interest loans under current financing models has proven to be difficult or time-consuming for small-scale nonprofit housing organizations. To expand the community housing sector, it is important to remove barriers to accessing financing for community housing projects and to expedite approvals. The public financing model, according to Alex, will provide easier access to government-backed construction loans. Another key to the success of this model is housing projects with break-even rents, based on construction and operation costs, to ensure a healthy revenue stream. Deeper levels of affordability, however, would have to be achieved through cross-subsidization or other cost-saving strategies. Steve sheds light on this.
If we can enable nonprofits to build at cost-based rents, and break even, drawing on loan financing type mechanisms, and then for those folks who can't afford them, if you're building a mixed income project anyway, build the whole project at cost-based rents, and then in 30% of the units stack a rent supplement or a housing allowance to allow low-income folks to live in 30% of the units. The high-end units, you can basically charge more than cost-based rents and make a profit, and use that to cross-subsidize a bit as well. So a little bit has to do with how they structure the type of development and the kind of income mix, but it also has to do with how governments, as partners with the nonprofits, design their programs and provide the right types of subsidy.
Although cross-subsidization has not worked everywhere for everyone, especially for small housing organizations with limited capacity, cross-subsidization through a portfolio approach has proved successful for bigger organizations, such as Société d'Habitation et de Développement de Montréal and Capital Region Housing in Edmonton. Both organizations have developed a mixed tenure or a mixed income portfolio, which allows them to cross-subsidize affordable rental units with market-based developments, including ownership projects. Land represents the biggest cost for housing construction. Increasing density for community housing projects through zoning policies is therefore an important strategy for cost saving. And Alex explains how this might make a big difference for community housing.
By making multifamily zoned land less scarce, that's in itself helpful to the nonprofit sector in easing that competition. But in addition to that, one thing I would advocate for is essentially doubling the allowable density for non-market and public housing. Take what the existing zoning is in any given area and double it for nonprofit housing, which we know we desperately need. And that's going to mean that in any case where a nonprofit proponent wants to bring a project forward, they're always going to be able to outcompete.
Faced with challenging funding and policy environments, the community housing sector has demonstrated strong resilience by coming up with innovative practices, forming multi-sectoral partnerships, and embracing an entrepreneurial spirit. Nonetheless, the continued growth of the sector requires transformative thinking and big ideas. The scarcity of community housing is not a fixed reality. It is a policy problem that needs to be addressed. But how? We'll explore the answer to this question in our last episode. Stay tuned. Thank you for tuning into Demystifying Community Housing, a special series from the Policy Options podcast. The production of this podcast series is led by Yushu Ju and Meg Holden at Simon Fraser University as part of the Community Housing Canada project and the Housing Inequality in Canada project, in collaboration with the IRPP. This episode has been a dedicated collaboration with production assistance by Ricardo Montrose and Luc Moulinson and audio by Jackie Garnett. If you like what you heard and would like to know more about the Institute for Research on Public Policy, head over to irpp.org. As we move through this work on exploring policy solutions for access to community housing across diverse geographies, it's important to recognize the ancestral territories we're currently on. We're grateful for the opportunity to work on these lands. To our listeners, we encourage you to visit native-land.ca to identify the Indigenous territories you're on and acknowledge the land's Indigenous heritage. For additional resources and information recommended and referenced by our guest speakers, be sure to check our show notes and the description. We'll be back soon with more episodes. This was Ricardo Montrose. Thank you for listening.